Good morning all, and thank you for joining Techstep's Q4 presentation. My name is Børge Astrup, and together with Anita Huun, we will take you through the operational highlights of the quarter and the financial results. Techstep is a purpose-led organization designed to help customers with smarter mobile technology. By making the world of work smarter and more sustainable through mobile technologies, we make positive changes to the world of work, freeing people to work more effectively, securely, and sustainably. To have a clear vision and mission is critical. It's our guiding star in everything we do in Techstep. From developing software solutions, attracting talents, developing our organization, winning new customers, and delivering high value to our existing customers and stakeholders. Techstep is a mobile technology company that helps customers to utilize software and hardware. We are the only mobile technology player in the Nordics that help customers to deliver managed mobility, including software, advisory, and hardware. We have solutions for those that work in an office and those that work out in the field, also known as frontline workers. We have some of the leading consultants within mobile technology in Nordics and perhaps in Europe. In Q4, two main focus areas were to finalize the capital raise and implement the cost optimization program with a focus on turning Techstep profitable. The KPIs has been strengthened. We have 1.3 billion in turnover with a focus on building recurring revenue base, which now has grown to 303 million, of which 111 million is from our own software. For many years, Techstep has acquired and developed mobile technology solutions, where the focus has been on acquiring products and investing. Techstep comes from a focus on hardware and transactional business, with a silo-based structure, with many products and limited focus on integration and synergies. We are now a software and service company with our own software. We have a scalable business model with a focus on recurring revenue, where hardware, advisory, and service are additional services. For 2023, it's all about execution. 1, we need to execute on the final phase of the transformation. We are now at the crossroad, and perhaps the most exciting time in Techstep history. We have gone from being a hardware company to a software and service company, where we help customers to be able to utilize the mobile ecosystem. We now have a product portfolio that solves specific challenges for our customers. 2, execute on the cost optimization and turn Techstep profitable. It has taken time and cost a lot of money, and we are adjusting the cost base and the organization with the full focus on delivering our software and services. The effect of this is 90 to 100 million in reduced cost base. 3, execute on upgrading existing customers to the new product portfolio and win new customers. We have set new goals of delivering more than 540 million in net gross profit, more than 225 million in software ARR, and more than 150 million in EBITDA in 2025. The result is now that we have one organization that are rigged to deliver our solutions to new and existing customers, where we have many large public and private customers without a recurring agreement. I have been working with selling software my whole career, and when I look at the products that Techstep can offer, the setup of what we can deliver and how we can deliver great customer value, it all comes down to our execution. So, let me take you through some of the highlights for Q4. With signing an extended agreement with ESS, the commercial momentum continues. The extended agreement has an ARR of 850,000 on our own smart device software. This is in line with our growth strategy to move customers from transactional to recurring services, meaning providing full value of the portfolio. We have more exciting opportunities in the sales pipeline and really look forward to 2023. The recurring revenue is increasing, while the net gross profit in Q4 is trending on par with full year, with stable and flat development in Q4 and 2022. Total recurring revenue is growing in Q4, driven by an increase in ARR from our own software to 111 million, in line with the strategic objective to lead with software and scale with recurring revenue. The cost optimization plan communicated and implemented earlier this quarter is on track, with a positive EBITDA adjusted for the first time in 8 quarters. As the cost optimization is filtering through in Q4, we achieve a positive EBITDA adjusted, with a decline in OpEx and salaries. With the capital raise of 103 million, the balance sheet has been strengthened. The net interest-bearing debt is reduced with 50%, creating flexibility through the final phase of the transformation. Mobile technology is one of the fastest growing technologies that may ever have hit the market. The areas you see on this slide is the core of the development and what is important for organizations both now and going forward. Mobile devices has become one of the biggest investments in most organizations. The price of mobile devices are increasing, and the organizations lack both the competence and solutions to handle and utilize the potential. When we talk to customers, there are 2 key areas that they focus on. Efficiency and sustainability is on top of their agenda these days. The questions our customers ask us is, how can we increase the efficiency while we reduce the cost and gain control? How can we be more sustainable and handle the life cycle of mobile devices with reduced cost and increased environmental benefits? With our new product offering, we can help organizations to solve these challenges. We have designed our portfolio to simplify how customers can increase efficiency, reduce cost, and reduce the environmental impact. Smart Device helps organizations to have a clear and simple policy: the purchasing of the mobile devices, service when it's needed, and return solutions. The solution is built as a self-service solution, enabling organizations to automate every step of the lifecycle journey for their mobile devices with better control for the organization. Electronic waste is a big challenge. Smart Device is built on circular economy principles through automated processes where we make sure that the customers can use their time and effort on the core areas in their organization, while we help them to increase the efficiency, reduce the cost, and reduce the environmental impact. From our solution, customers will get an overview of emissions data for the devices that they have purchased, making it easy to do the climate reporting and to get the insight to support their emission reduction plan. The calculations show that organizations can save between 4,000 and 10,000 NOK per employees based on direct and indirect cost with our portfolio. The level of savings will vary based on the willingness and the maturity of the customers. Not all customers are at the same level, and that's why we have different steps. The majority of all organizations are at the first step, when they have rolled out devices to their organization. The product portfolio is designed to drive upsell and to give customer increased value. Through Smart Device and Smart Control, we now can triple the gross profit by upselling the customers to a potential of 115 NOK per user per month in net gross profit, while we at the same time can help customers to gain control and save cost. Many organizations also have employees that do not sit behind the desk. Where the employees needs to increase their efficiency and quality, as the organization can optimize their cost through our SmartWorks offering. The average net gross profit for SmartWorks is 380 NOK per user per month, which gives 10 times higher net gross profit than before the transformation. As mentioned earlier, we have signed an extended agreement with ESS on smart device. So now let us look at that journey. ESS is a leading workplace experience and facility management company with a substantial focus on sustainability. The initial contract we had with ESS was to purchase hardware from us. They have now upgraded to our full lifecycle services, enabling them to utilize the full potential of the solution while they at the same time increase the efficiency for their 1,700 employees, reduce their cost, and reduce the environmental impact. With Smart Device, ESS gets better control and are able to reduce their cost per employee. They get full control of the devices for their 1,700 employees. They get freedom for the employees to choose their preferred device, while the cost is the same for ESS. They get a fully automated lifecycle solution for their employees and a solution that builds on circular economy principles that will help them to achieve their sustainability goals. ESS and Techstep share the same view on use, reuse, and recycling of resources. We're proud to have a solid relationship for more than 12 years and thank ESS for their renewed trust. I will now hand over to Anita Huun that will take you through more details on our financial results for the quarter.
Thank you, Børge. Before we deep dive into the Q4 numbers, it's good to take a bit of a helicopter view for the full year 2022. Transforming a company in the degree Techstep has takes time, and this is also reflected in our financials when we compare the full year results 2022 to 2021. On an annual basis, revenue and net gross profit is stable and flat, while the underlying profitability is improving. This despite that the cost optimization has had limited impact in 2022, as the full effect will be very much more visible going into 2023. We have seen a positive underlying trend the last few quarters, and we are delivering on our strategy to grow our scalable and sticky recurring revenue base. So even though we are disappointed that 2022 did not show the net gross profit growth we were aiming for, data shows that we are moving in the right direction, setting us up for profitability in 2023. In the fourth quarter of 2022, revenue was 370 million compared to 384 million in the same quarter previous year. This corresponds to a 4% decline in reported revenue, but organic revenue was only down 1%, adjusting for the sale of the voice and contact center business. The voice and contact center business was sold in Q1 2022 and contributed with almost 40 million in revenues and 22 million in gross profit last year. Q4 2022 is the last quarter where we'll have negative comps due to this divestment. ARR from our own software passed the 100 million mark for the first time in Q2 and continues to increase. ARR is up 14% organically versus last year and almost 7% sequentially. This is the strongest sequential growth we've seen in quite a while. We do see momentum building with the launch of our new product portfolio with a clearer value proposition and commercial packaging, and the ESS deal that Børge highlighted earlier is a very good example of this. Net gross profit in Q4 was on a pro forma basis up 8%, adjusted for the divestment. Net gross profit margins are improving from 25% to 27%, driven by the better product mix during the quarter and higher margin sales business. Q4 marked a positive change in EBITDA adjusted, as some of the cost efforts are filtering through and being in a positive terrain for the first time since 2020. Techstep is still running on a loss on a net profit level, but approximately half of the Q4 loss stems from amortizations, which are non-cash effect, And on top of this, we did book an 8 million one-off cost related to restructuring, and that has a negative impact this quarter. We have seen a strong improvement in cash flow from operations in the second half of 2022, as we also communicated it would be. In Q4, we saw positive cash flow from operations, and this together with the 103 million capital raise, were cash inflow in Q4, half the net interest-bearing debt from Q3 to Q4. Our net interest-bearing debt exiting 2022 was down to 113 million, significantly improving the balance sheet and liquidity. In Q3, we introduced new operating metrics for Techstep, which are better aligned with our operating model and underlying profitability. One of these metrics is net gross profit. Net gross profit is gross profit adjusted for depreciations related to our hardware as a service portfolio, as leasing falls under IFRS 16 rules, and as such, these costs are booked as depreciations instead of COGS. That is why we have adjusted for these, and at the same time move from EBITDA to EBITDA as our preferred operating KPI on profitability, also better aligned with our cash flow. Ending 2022, the 12 months rolling net gross profit was 367 million, which corresponds to a very stable and flat development over the last couple of quarters. The decreasing trend reported in advisory and services is to a large extent driven by the divestment of the voice and contact center business, which was divested from Q1 2022. Hardware and other continues to make up a large part of our net gross profit and is a very stable cash generative business for us. It is great to see the GP improvement in our own software portfolio, which is up almost 22% versus the end of 2021, which also compensates for the divestment effect from the advisory and services business. This is aligned with our goal to lead with software, which also have positive ripple effects on advisory and services and on the hardware business. The key focus for Techstep is growing our overall profits, and particularly our recent wins on the software side is important to be able to do this. Techstep has a unique growth opportunity with our software solution and has built a solid IP portfolio over time, both organically and through acquisitions. This is also where much of our future growth ambitions lies. We ended 2022 with an ARR on our own software portfolio of 111 million, corresponding to an organic year-over-year growth of 13%. Despite the strong sequential improvement in Q4, our ARR is impacted negatively by churn from our earlier hardware as a service customers residing on the old platform, making it challenging to reach the 115 million target for 2022. With our new portfolio being launched in the latter part of 2022 and still more launches on the way in the first half of 2023, we expect this to translate to a steeper growth rate going forward. We have an ambition of reaching more than 140 million in ARR in 2023 and double the revenue from ARR by 2025, reaching above 225 million. Techstep continues to ramp and grow the recurring commitment between the company and our customers, which gives us much more predictable revenues and cash flow generation longer term. We're therefore very happy to see the record high recurring base this quarter with revenues of 303 million. The sequential growth in Q4 is mainly driven by our own software portfolio, while the development in hardware as a service and advisory was flat. As we said earlier, we have seen some of our early hardware as a service customer churn residing on the old platform that has impacted the recurring revenue from hardware as a service. Many of these customers have moved to transactional purchases, so therefore this is very undramatic for Techstep. For Techstep, growing the recurring revenue on software and advisory side is more important as the margins here are significantly higher and customers can buy either through transactional or as a service. Techstep divested the voice and contact center business at the beginning of 2022, while Famok was acquired in Q2 2021, and therefore we still provide visibility on our pro forma figures. The voice and contact center business was seen as non-core asset, but it did include 22 million in gross profit in 2021. The top graph shows our quarterly performance on a pro forma basis. Techstep's Q4 net gross profit was up 8% to 100 million, and the conversion from net gross profit to EBITDA increased quite significantly from -6% last year to 2% this year, marking the first quarter with positive EBITDA adjusted. In Q4, we still have full running OpEx and payroll cost for employees who are part of the restructuring done in Q4. As such, the cost savings will be visible moving into 2023. If you look at this over a 12-month period, the below graph, we saw a declining trend in EBITDA conversion throughout 2021 as our gross profit in H2 last year was impacted by both hardware delivery issues and lower hardware margins, while we at the same time continued to invest in our transformation towards a recurring revenue business model and into our technology platform. Since Q1 2021, the trend has definitely changed, and Q4 this year marks the fourth consecutive quarter with improved conversion rates. The trend is clear, and 12 months rolling EBITDA adjusted has more than doubled since its low in Q4 2021 on a pro forma basis. Our 2025 goal is a net gross profit conversion above 25%, making sure we return shareholder value after a long period of investments. Our commitment is to turn Techstep profitable. Our equity ratio after Q4 stands at 43%, slightly up from 41% in Q3 due to the inclusion of proceeds from the capital raise. Intangible assets are mainly goodwill of 604 million and customer relations and technology of 182 million. Tangible assets mainly include devices delivered to customers through our hardware as a service portfolio, almost 168 million in total. The devices are owned by external funders, not Techstep, but we capitalize it on our own balance sheet. Ending 2022, Techstep's long-term interest-bearing debt was 91 million after refinancing of our bank loans as part of the capital raise in September. 50 million was moved from short to long-term debt, securing flexibility going forward. Our short-term interest-bearing debt was 83 million after the end of this year, after the end of 2022, which includes the last portion of seller's credit of 28 million and 28 million in utilization of our credit facilities. The remaining 27 million is repayment of acquisition loans. Net interest-bearing debt was 130 million at the end of the year, more than half from Q3, creating more flexibility for Techstep. H1 was a very capital-intensive half year for Techstep as the transformation was in high investment phase and our working capital was building. As we communicated during Q2 2022, we expected to see an improvement in cash flow from operations during the second half of 2022, which it also has. In Q4, we saw a much better development and cash flow from operations was 66.3 million. This was mainly driven by 38 million improvement in working capital. On a full year basis, cash flow from operations in 2022 was in line with last year, corresponding to the overall results, stable and flat for the year. CapEx related to software development and IT investments was significantly down in H2 versus H1, and Q4 CapEx was only 8 million, a third of the level versus corresponding quarter last year. We continue to invest in our own IP and finalization of some project, but CapEx is expected to come down going forward. Proceeds were used to repay debt during the quarter, and cash equivalents improved by 32 million from Q3 to Q4. In 2022, our total cost base was 442 million, but this includes all costs for employees that were affected by the restructuring and limited impact from our cost optimization effects. This means that our run rate on cost going into 2023 is much lower, and that the real impact on cost savings will be seen from Q1 and going forward. We booked a 8 million one-off cost related to the restructuring, which was also communicated during the third quarter. Techstep's goal is to reduce its cost base by 90 million to 100 million and have, during the budget process in Q4, found areas where this will take place. Headcount during Q4 was reduced by 45 people, while the remaining cost savings will come from better utilization of general OpEx and lower need for IT investments and external CapEx. So cost optimization is on track. Techstep is on the path to profitability, and the first positive EBITDA in 8 quarters in Q4 marks the first step on this journey. The last 4 quarters has shown an improving profitability as well, despite still being in an investment phase. Our goal is to grow net gross profit in 2023 by approximately 50 million from increased software sales and higher gross profit areas. Coupled with the 90 to 100 million cost optimization plan, large improvements are expected already in 2023. Børge will now summarize and give some closing comments.
Thank you, Anita. So let me summarize. Our offering and organization is built to solve the 3 main challenges organizations have when it comes to mobile technology. 1. The lifecycle management of devices. 2. The management of the mobile ecosystem and security. 3. Increase the efficiency, quality, and safety for their frontline workers. We lead with software and offer a complete mobile management solution for customers, where we assist organizations in effectively managing and extract value from their mobile devices. We continue to deliver high value to our customers through our recurring services, and we are proud to see that customers upgrade their services, resulting in a growth in recurring revenue for Techstep. We have restructured Techstep to be a software company with a positive tag-along effect on both hardware and advisory and services. We reduce cost while we maintain the commercial momentum. The cost optimization plan is on track, and we delivered a positive EBITDA adjusted for the first time in 8 quarters. We raised capital, strengthened our balance sheet, and reduced the net interest-bearing debt with 50%. We have set new clear goals. With 2022 and Q4, we showed that we are on track for reaching the overall company targets for both 2023 and 2025. And that concludes today's presentation. Thank you for your attention. Please also join Anita and myself in the Q&A session today at 8 o'clock. You can always submit your questions to us using the investor relation email address or during the session using the chat function. Hope to see you there soon.